Welcome to vTalkInsight, Risk Sentiment Daily for January 30th, 2026. Global markets are wrestling with powerful crosscurrents today as an AI-driven investment boom collides with a sharp spike in commodities and a jump in single-stock volatility. Let's unpack what that balance means for risk sentiment and how it's shaping positioning across assets. Across assets, today's risk mood is best described as balanced and hedged. Under the surface, growth optimism and strong earnings in key pockets are still supporting risk appetite, but a combination of commodity shocks, tech earnings stress, and rising volatility is clearly capping enthusiasm. On the equity side, broad benchmarks are little changed to slightly softer, with modest index declines despite healthy economic data and solid results from several large companies. Volatility remains contained at the index level, with measures like the VIX sitting in the mid-teens, yet single-name moves are becoming much more extreme. Compared with recent sessions, when sentiment was cautiously risk-on, the pattern now looks more two-sided. Investors are still willing to take risk in areas levered to AI, commodities, and cyclicals, but they are simultaneously ramping up hedges through options, gold, and cash-like instruments. Large intraday swings in copper, record levels in gold, and sharp moves in Bitcoin all signal a more nervous backdrop, even as private equity dry powder, strong IPO pipelines, and resilient bank earnings argue that the underlying risk-taking machinery is very much intact. Overall, markets are expressing conviction in the growth story while paying more to ensure the downside. A key feature of this environment is dispersion rather than broad risk-on or risk-off. Within tech, some megacaps are selling off hard on earnings concerns, while others are rallying on strong AI execution. In commodities, industrial metals, energy, and precious metals are moving together to the upside, but for very different mixes of growth optimism, supply stress, and safe haven demand. This dispersion is encouraging greater selectivity, but also raises the cost of getting idiosyncratic calls wrong. With that backdrop in mind, let's dig into the main bullish forces still supporting risk appetite before turning to the key downside risks. AI-driven capex and earnings remain the primary engine of bullish sentiment. Megacap platforms are committing staggering sums to AI infrastructure. Meta is talking about capital expenditure potentially reaching around $135 billion this year, an increase of close to 90%, backed by revenue guidance in the high 20s to low 30s%, well ahead of prior expectations. Investors rewarded that combination of strong top line and aggressive AI investment with an immediate share price jump, signaling that the market still pays up when spending is clearly tied to growth. The boom is broadening beyond the obvious hyperscalers. Semiconductor capital equipment makers report order backlogs nearly twice their quarterly revenues, reflecting structural demand for fabrication tools as AI data center build-outs strain existing capacity. Memory and storage names like Western Digital and SanDisk are beating expectations, raising guidance, and enjoying historic gross margins thanks to tight supply and AI-related demand. Private capital is chasing the same theme. Blackstone cites data centers as a key driver of a record quarter, while large strategic investors are reportedly exploring multi-billion and even tens of billions of dollars in commitments to leading AI model providers. The implication for markets is a longer and deeper AI investment cycle than many expected, supporting earnings in hardware, infrastructure, and selected platform companies. However, the bar to sustain valuations is rising. Microsoft's experience shows that heavy capex without convincing revenue acceleration can trigger double-digit share price declines, and concerns about over-reliance on partners like OpenAI highlight concentration risks in some business models. The narrative has shifted from blanket AI optimism toward discriminating between winners and losers. Investors are watching whether robust capital spending continues to translate into genuine productivity gains and durable revenue growth, which sets the stage for the next driver, how that enthusiasm is spilling beyond a narrow set of megacaps. Broadening risk appetite beyond megacap tech is another important bullish force. Market leadership is no longer confined to the largest AI beneficiaries. Equal-weighted indices and small caps have started to outperform their cap-weighted counterparts, and retail call buying in small-cap stocks has pushed into the 90th percentile, suggesting a deliberate shift toward previously under-owned areas. Cyclicals are responding as well. Companies like Caterpillar are beating on revenue, citing robust construction demand, while consumer names such as Deckers are raising full-year guidance and recovering from prior drawdowns. Financials and resources are joining the rotation. European banks such as ING and Lloyds are reporting strong profits, higher medium-term return targets, and share buybacks, underpinned by resilient credit quality and solid capital generation. Basic resources stocks in Europe are outperforming as copper prices surge, with sector indices up meaningfully on days when industrial metals rally. At the same time, sectors tied to fiscal expansion, industrials, materials, defense, and banks are viewed constructively, reflecting the support from public spending alongside private capex. IPO activity reinforces this broadening tone. Both Nasdaq and UK listings pipelines look unusually strong for this point in the year, spanning technology, healthcare, consumer, and fintech names, which points to improving primary market conditions and a willingness to underwrite new equity risk. There are still pockets of caution. European banks are unlikely to repeat last year's outsized share price gains given elevated expectations, and some commodity-linked names are now tethered to highly volatile underlying prices. Even so, the shift from narrow megacap leadership toward a wider opportunity set signals a more resilient risk backdrop, which interacts closely with the macro environment and central bank stance. Resilient growth, a Fed pause, and attractive carry form the third key bullish pillar. The Federal Reserve has paused rate cuts and is signaling a high bar for further easing, citing stronger than expected growth, stabilizing labor markets, and a still manageable inflation outlook. Policymakers appear comfortable with an extended period of unchanged rates, while leaving the door open to cuts later in the year, if conditions warrant. Market pricing leans slightly more dovish than official guidance, with expectations for 1 or 2 cuts this year, but both sides agree that the era of aggressive hiking is over. This backdrop is constructive for fixed income. Real interest rates are viewed as appealing, and investors are increasingly considering extending duration now that policy rates look broadly balanced relative to fundamentals. The end of the hiking cycle supports carry strategies in government bonds and credit, and recent data show strong foreign purchases of U.S. equities and nearly $1 trillion in other U.S. assets over just 4 months. In Europe, inflation is not expected to be a major problem this year despite higher metals and materials prices, although margin pressures could emerge for some industries. At the macro level, fiscal stimulus and robust consumer spending are contributing to above-trend U.S. growth, even as lower-income households remain under strain, creating a K-shaped pattern. For markets, that means corporate revenues and profits can stay resilient while political focus tilts toward affordability and redistribution, which in turn may support out-of-favor defensives like consumer staples. The main risk to this benign mix is an inflation surprise, which could force the Fed away from its comfortable pause. That risk is most visible in the commodity complex, which is where the bearish side of today's narrative begins. Commodity spike and renewed inflation risks are at the top of the bearish list. Gold, silver, and copper have all surged to or near record highs. Gold is trading above $5,500 per troy ounce, silver is up more than 60% year-to-date, and copper has posted single-day gains of 8 to 12%, moves that are extraordinary for a normally stable industrial metal. At the same time, Brent crude has climbed roughly 6% in just 3 days, approaching $70, with both Brent and WTI at their highest levels since last September. These moves have several implications. First, broad commodity indices are nearing record territory, signaling building inflationary pressures and feeding concerns that the disinflation trend could stall. Higher oil prices risk undermining the consumer tailwind from previously lower gas prices, particularly for more fragile households. Second, The drivers are a mix of genuine supply constraints, such as copper and aluminum deficits in the hundreds of thousands of tons, and geopolitics, including escalating tensions around Iran and rising energy security worries. There are mitigating factors. A weaker dollar should only marginally lift U.S. import prices given the limited role of imports in overall inflation, and in Europe, inflation is still expected to stay broadly contained this year, even with higher input costs. In industrial metals, substitution into steel, plastics, or other materials, and the disconnect between prices and still subdued Chinese downstream demand suggest current levels may be hard to sustain. However, until the rally breaks, the risk is that central banks face a more complicated trade-off and margin compression spreads through materials-intensive sectors. That interacts uncomfortably with another pressure point, growing stress within parts of the tech complex. Tech earnings stress and AI dispersion are challenging the assumption that megacap technology will always support the indices. Recent results show investor reactions diverging sharply. Microsoft delivered record capex, with quarterly spending up 66% to around $37.5 billion, yet slowing cloud growth and concerns about the payoff from AI investments drove the share price down more than 10%. Other software names, including SAP and ServiceNow, have suffered double-digit declines as markets question how large language models will reshape traditional software business models. Structural concerns add to the volatility. Nearly half of Microsoft's vast future contract backlog is tied to OpenAI, raising questions about concentration risk and the durability of that partnership, even though the agreement runs well into the next decade. Some brokers have removed the stock from top pick lists, citing cloud deceleration and capex running ahead of revenue. More broadly, the software sector is experiencing a tech-led drawdown as investors reassess which platforms have defensible moats and pricing power in an AI-rich world. Importantly, this is not a uniform tech bear story. Meta, Apple, select AI hardware names, and several memory and storage providers are all seeing positive earnings surprises rewarded with sharp share price gains, helped by clear linkages between AI spending and revenue growth. The result is a market where correlations among major tech stocks are unusually low, and single stock volatility has surged relative to index volatility. For portfolios, that means index exposure is a less reliable shortcut to the AI theme, while stock selection risk is materially higher. That heightened dispersion is one reason why hedging activity and defensive positioning are building in the background. Volatility spike and defensive positioning round out the bearish side of the ledger. While index volatility remains moderate, single-name risk is elevated. Volatility in megacap tech has climbed toward historic highs relative to the broader market, reflecting sharper post-earnings moves and lower correlations among leaders. Options markets show retail investors turning more cautious, with a notable drop in call buying and increased call selling across many names, signaling limited confidence in near-term upside during earnings season. At the same time, flows into perceived safe havens are notable. Gold has not only reached new highs but is experiencing outsized weekly gains amplified by thin liquidity and dealer hedging, making intraday swings more violent. Bitcoin, often touted as a diversifier, is selling off sharply, down around 6% on the day in recent trading, raising doubts about its reliability in periods of macro stress. Significant cash remains parked in money market funds even as real rates are attractive elsewhere, underscoring a persistent preference for liquidity. Policy and geopolitical uncertainties help explain this behavior. Investors are watching the rising risk of a short U.S. government shutdown, continued tensions around Iran, and a broader shift toward more polarized and anti-globalization policies in many economies. These event risks are supporting demand for commodities, particularly gold and industrial metals, even though overall market volatility has not spiked dramatically. In combination, elevated single-stock volatility, heavy use of options, and robust safe haven and cash balances point to a market that is still engaged on the upside but far from complacent. That leaves the balance of risk sensitive to surprises on growth, inflation, or policy. To sum up, risk sentiment is finely balanced. An AI-driven capex and earnings boom, broadening market leadership, and a resilient growth backdrop under a steady Fed keep the medium-term tone constructive, while a powerful commodity rally, tech earnings stress, and a buildup in hedges and safe haven demand are tempering near-term enthusiasm. Watch how commodities, single-stock volatility, and Fed communication evolve alongside the next wave of earnings. The interaction between growth resilience and inflation risk will be critical in determining whether today's hedged positioning persists or gives way to a more directional move. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.